This Friday sees the US jobs report roll around, and we've already seen some questionable numbers coming out of the likes of the ADP figure. We've also seen some pretty concerning ISM numbers as well. So let's delve into the data on the US economy at the moment and try to ascertain exactly how this jobs report could impact the likes of the US dollar, US stocks, and the likes of gold. So here we go. This is the market expectations according to Trading Economics. 130k expected from 177 last time around. Remember, last month we saw a very low ADP number. We came into the job report thinking maybe that's indicative of a weak payrolls figure. No, we saw 177. And so we saw a major outperformance. This time around, we are expecting a decline, but not necessarily a dramatic one. But we have since seen the ADP numbers, which could point towards, well, who knows whether this time it's going to be relevant or not. Unemployment 4.2 expected to remain. Average hourly earnings remaining at 0.2. So wage and price pressures kind of under control from that perspective. And so, yeah, it's an interesting one. I mean, ultimately, we're coming into this at a time where we're questioning whether the jobs market's going to roll over or whether we're going to see inflation surge once again, and whether that's going to have an impact on the outlook from the Federal Reserve. And like I said, we did see that weak ADP number. The JOLTS numbers better than expected, and job openings moving towards the upside. But let's look at some of the different charts, and we can kind of get into some of this data. So the first chart I wanted to show you guys essentially wraps up the dual mandate faced by the Federal Reserve. Essentially, they need to keep inflation under control, which we can see on the top end here, which is the core PCE price index level, currently at 2.52. And they need to stop unemployment from rising. So those are the two elements. Now, you don't necessarily just need to look at unemployment, because within this jobs report, we have other metrics, which might be the likes of non-farm payrolls. So instead of seeing a massive surge in terms of unemployment, if we saw very weak non-farm payrolls numbers, then that could also signal distress within the jobs market. And of course, there's other metrics apart from the core PCE price index. Essentially, those are the two sort of factors that the Federal Reserve will be looking into, and which will be driving expectations of what the Federal Reserve could do going forward. Like I said earlier in the week, we did see the ADP non-farm payroll figures coming out, and they came out very weak. Last time around, they disappointed at 60k. This time was even worse. That's a downward revised figure of 60k. This time around, it was even worse, 37k. Now, we can see at the bottom that I've highlighted that we often see pretty significant differentials between the headline payrolls number on Friday and the ADP number. It's not to say that one is a perfect indication of where the other one's going to go. But often it is the case that if ADP moves higher, then maybe the payrolls number on Friday might move higher. It might not necessarily be the same kind of number. But this time around, given that massive gap that we've seen, 177 last time around and now confirmed at 60k, that's a huge gap of 117. So what we're going to do this time, there's a good chance we do see a decline. Of course, markets are expecting a decline in terms of the payrolls number, but 130k is expectations. It does point towards a potential for underperformance. But last time around, it didn't really indicate much, because the payrolls number actually beat expectations despite the weakness of the ADP number. So certainly that's a significant indication that we have been looking at earlier in the week, that potentially we could see weakness in terms of the payrolls figures. Inflation, of course, like I said, is the other side of the story. So wages are the sort of inflationary metric that we're going to be looking at. Within this, of course, if we see rampant wage growth, then that means that businesses are likely to raise their prices in response. In actual fact, we've seen wages sort of drifting lower, 3.77 on the average hourly earnings figure. And you can see that that kind of goes hand in hand with the decline that we're seeing in core CPI as well. And if you look at last 3 months, annualized out to a year's figure, in actual fact, the last 3 months were particularly low. And you can see that they're at the bottom end of the range of 3-month annualized wage growth figures seen prior to the pandemic. So we're pretty much at a relatively normal level now when it comes to wages. So that inflation side of things, unless we see a major spike in terms of wage growth, it appears to be under control, as if we're just looking at the last few months. Then earlier in the week, we saw the ISM services PMI report, and that followed on from the manufacturing figures. Now, what's really good about these is they break out a number of different elements around what's happening in the US economy right now. So we can see exactly where sort of inflation pressures are going, what's the jobs market looking like in that sector, what's new business, new orders looking like. So many different elements. The disappointing thing about this report is we saw further upside in terms of prices. So inflation continuing to rear its head, and downside in terms of business activity, but most notably new orders, collapsing new orders. Of course, we're looking at a period of time where there's great uncertainty given tariffs. So it's no surprise that businesses abroad are probably going to be holding off for periods of time to see exactly how things resolve. And then price pressures, well, ultimately, you're going to see higher prices as you see tariffs coming into play for the most part, because goods coming into the country are going to be taxed. May just be 10%, or it depends on your industry, really. And certainly when we look at manufacturing, it's a similar kind of story. Now, that figure has at least started to flatline, but it's around that 70 mark. So it's very lofty indeed. And if you look at the previous one, we're sort of approaching 70. So both of them, rampant inflation pressures on show there, but these metrics aren't the same as your core PCE or your CPI numbers. So this is the sort of potential prelude to a resurgence in terms of inflation. You can see why the Federal Reserve are very hesitant to cut rates. So Donald Trump says, oh, too late, pal, he should be cutting rates right now. Look at what all the other central banks are doing. Well, this is almost entirely of Donald Trump's making. He's lifting inflation pressures through tariffs. He's lifting inflation expectations through tariffs. And that's particularly raising its heads here in the services sector, already very elevated in the manufacturing sector, and pretty dour readings when it comes to the rest of the bunch, all in negative territory when it comes to employment, new orders, and production. So all of that sort of, on the manufacturing side points to weakness in terms of employment, but you can see the employment metric and services, by and large, flat, just about in expansion territory. So not necessarily as concerning when it comes to the jobs market. I wanted to point out this conference board survey. So within that, they survey people to ask, are you finding jobs hard to find, or do you think the jobs are plentiful right now? And that gives you a sort of soft indication of how the jobs market is right now. And that can give you a leading indicator of how things might turn up down the line. Well, it's interesting because we saw the sort of switcheroo where previously there was a feeling that jobs were plentiful, more so than people responding saying that they were hard to find. But we've now started to see that moving towards the upside. In actual fact, that sort of crossover that we can see here, I'm mistaken because you can see here on the right and the left, we've actually got, they're not on the same scale. So you've got the hard to find on the right hand axis. The left hand side is for the plentifuls. So nonetheless, the trajectory is correct. So we're seeing a rise in those finding it difficult to find jobs, and a decline in terms of those finding it easy to find jobs. So arguably the jobs market is tightening up somewhat. That might be the case of full employment, or that might be a case of businesses just don't want to make those investment decisions. And that's probably more likely to be the case at the moment, given the uncertainty surrounding the economy and tariffs and global relationships. So if you take those two figures, the plentiful and the hard to find, you can create a ratio, which is what we've got here, the ratio of hard to find versus plentiful. And so we're seeing a resurgence because of that, what we saw on the previous one, right? So an increase in those finding jobs hard to find, a decline in those finding plentiful, and therefore that purple line starts to increase. And you can see that it's not perfect, but often goes hand in hand with a rise in unemployment, the unemployment rate. Now, it hasn't happened quite yet. 4.2% is what the unemployment rate is showing at the moment. But these are sort of tentative signs that could be the direction of travel. And certainly if we were to see a deterioration of the jobs market, then it points towards the Federal Reserve being pushed into action potentially sooner, or when they do come into action, they do it at a more rapid manner in terms of rate cuts. But we haven't seen that happen in terms of the big number, which is the unemployment rate, quite yet. This is a similar kind of story. So earlier in the week, we saw the JOLTS job openings number, and we saw weakness in terms of the sort of quits and layoffs versus discharges. But we didn't necessarily see that when it came to the job openings. The sort of job openings number actually moved towards the upside. But as you can see here, the orange line is on a downward trajectory. The caveat to that is this is a normalization after the sort of pandemic period. So we saw that boom, we're coming back down. We're actually coming back down towards levels seen pre-pandemic. So not necessarily as sort of concerning as you might think. But that quits divided by layoffs is another sort of signal of a soft signal of where things are at the moment, because if you quit, you're probably going to feel quite confident that you're going to get another job. But if you're laid off, then it means that the business perhaps can't actually pay your wage anymore, or isn't in a position to hire people into your role anymore. So those are the sort of two sides of losing your job, essentially. And so a rise in terms of quits means people are growing confident. We had actually seen a rise in that ratio of quits versus layoffs, but that's actually pulled back recently. But like I said, the key thing here is unemployment, right? When we see unemployment start to move sharply higher, that really starts to turn the screw and starts to point towards the Federal Reserve needing to do something, all else equal, i.e. if inflation doesn't rear its head. In terms of market expectations at the moment, we have actually seen a shift with some of this weak data that we've seen in terms of the ISM number, but inflation did rear its head on that front, and in terms of the ADP numbers. What you can see here is over the course of the past week, we've seen a resurgence in terms of expectations for those outlier rate cuts, where it's 3 rate cuts this year or 4 rate cuts this year. 4, very unlikely, but markets have been pricing essentially 2 rate cuts, which is down to 375 to 400. That still is the base case, but there's a climbing support for the 3 rate cuts this year camp, and a move away from those saying we're just going to see 1 more rate cut this year. So an increased clamor for rate cuts, additional rate cuts, and that comes with weak economic data and controlled inflation. So let's look at how this is going to implement what implications this could have in terms of the different markets that you might trade, right? So first and foremost, we've got the Citibank or Citigroup Economic Surprise Index. What this means is if the numbers in terms of the economic calendar are coming out better than expected, it will rise. If they're coming out worse than expected for the US economy, then they're going to decline. They've actually been rising recently, but it started to pull back recently. So more recently. So we're seeing a worsening in terms of the economic indicators of late. And you can see here in terms of the green line, that then points towards an increase in terms of the calls for rate cuts from the Federal Reserve, which is exactly what we saw on the previous chart, right? So the weaker the economic data, the more people think we're going to see rate cuts. What's the relationship when it comes to the US dollar? Well, generally, additional rate cuts should be dollar negative. Rate cuts, by their nature, sort of easing from a central bank, should be negative for the currency, and often it goes hand in hand with a sort of deterioration in terms of the underlying economics and a need for the central bank to step in. But what we've seen recently is interesting because we've seen a rise in terms of the expected rate by year end. So essentially at the December meeting, where will rates be? That's what the green line is. That's been rising, but the US dollar has been falling. And so really that highlights the fact that right now there's just very little support for the US dollar. But if we do see increased calls for rate cuts, so if we see weak data coming out, an increase in those expecting additional rate cuts this year, then it could ramp up the selling pressure on the US dollar. So let's kick off with the US dollar. We can see wanted to bring up dollar yen because I think it's an interesting one at the moment. So this is the US dollar against the Japanese yen. From a wide perspective, what you can see here is the potential for this to be topping out. Now, this has grave implications for the Nikkei 225 in particular, which has really sort of been built on the back of Japanese yen weakness. But you can see here potential head and shoulders formation if we do break the 140 support level. Now, more recently, we had sort of spiked upwards. That then provided us with what looks like just another retracement within a trend. So it's a deep fib retracement. Are we going to come into the 76.4? It is a 76.4 and absolutely perfect. Lovely. So we've come into a 76.4 fib. We've dropped down into your first major swing low within that, and now we're heading back towards it. And in actual fact, we've sort of got another head and shoulders formation here at that 142.35 level. Of course, generally head and shoulders formations are better at tops of markets as a major reversal signal, but nonetheless, the story is the same in this fact that we're seeing higher highs, higher lows, rallies into a retracement level within a downtrend, drops down, lower lows, lower highs, and a break below support then confirms that turnaround and heads back down towards that 140 mark. So this is looking like it's preparing to break back towards 140 and potentially below that. So a strong possibility that this is a big top here for dollar yen. Keep an eye out on this chart. I think it's a really interesting one. And like I said, you know, if you're looking at sort of Nikkei 225, but on a different price scale, if you're looking at the implications for this, look, this is the Nikkei 225. So if we see, you know, if we see dollar yen rolling over in a meaningful way, Nikkei 225 could very easily go with it. And you've actually seen the Nikkei rallying recently, where we're seeing dollar yen staying low and threatening to break lower. So in actual fact, that could point towards a dramatic sell-off if we did see that break of support for the likes of dollar yen. Right, next up, let's look at the implications for, where are we? There we go. The implications for, there we go, gold. So gold, we can see here that the recent relationship between gold and rate expectations, just making sure that I know what's what. So yes, we've got gold inverted. So essentially, if the blue line goes down, it means gold's going up, right? Sorry to confuse you. It just doesn't look that great if you don't invert it, because you can't see the relationship that well. So essentially what's happened here is that gold has been gaining ground, particularly during periods where markets are expecting to see additional rate cuts. But then more recently, what we have seen is that resurgence in terms of rate expectations. So essentially an easing or a cooling of those rate expectations recently, where we saw sort of stronger data, fears over inflation, people start thinking maybe we're not going to get many rate cuts. That should be detrimental for gold prices. But what we've seen instead is gold's essentially just been in consolidation mode while that sort of rate expectations figure rose. And so for me, I think that means that there's this innate strength within gold right now. That means even when the conditions turn against it, it still holds up relatively well. But if it turns back in its favor, I would expect gold to do very well as a result. So let's look at gold through the prism of, if we see the data coming out poorly and if that indicates additional rate cuts. Because if we don't, if the data comes out with a strong figure, then, you know, it's kind of more of the same, and then gold's probably going to be doing more of the same, which is sort of consolidation. So let's look at exactly that, and we'll be able to gauge exactly where we could go from here. So looking at the chart for gold, we can see that the long-term trend, of course, if we go on a monthly time frame, it's lovely, and probably better to put that in a log scale so you can sort of see a bit more of the granular detail. If we look into the sort of near-term trend, you can see that more recently, at the time where we're seeing question marks over the amount of easing that's going to take place, all of a sudden we get into this consolidation phase. Now, that's set within a very bullish market because we'd seen this strong rally here in April. And since then, we've now seen this ABC style retracement, which is often how those retracements sort of play out, which is part of Elliott wave theory. And that C appears to be the bottom in my mind. Now, we have got a fib level that was the potential to be resistance here, which is the 76.4 fib, 3364. That's now been taken out. So we've moved that. That gives me greater confidence that we are going to break the 34.38 and ultimately break up into new highs, essentially through 3,500. Key to that is if we see weak data on this jobs report, you know, weak data in terms of higher unemployment, lower payrolls, that kind of stuff should be good for gold, in my opinion, and would point towards a potential breakout through resistance and a continuation of that wider trend. So certainly this is going to be a really interesting market to be watching out for at this report. And then let's just look finally at the outlook for the Nasdaq. So this time around, I've brought back the Citigroup Economic Surprise Index. I've brought back the expectations of where interest rates are under the Federal Reserve by year end, and I've overlaid it with the Nasdaq. What does this tell us? Right, what this tells me is that the Nasdaq at the moment is not trading on the back of bad news is good news per se. In fact, it's trading on the idea that we don't necessarily care that much about needing loads of rate cuts, because rate cuts go hand in hand with economic deterioration. Instead, we want to see strong economic data. It means we're not heading towards a recession in the US, and some of the fears around tariffs essentially battered aside. That's the current relationship. So strong data is coming out positively for the Nasdaq and tech stocks essentially. So that means if we come in with weak data, it could cause this index to start to roll over. If we come out with strong data, and once again the payrolls figure beats, then the place to be is probably going to be the Nasdaq. And that has been an outperformer of late. You would expect it to be doing the same if we see strong numbers coming out of this jobs report. So this is the long-term weekly chart. Very impressive. We saw this big collapse. Well, we've pretty much recovered all of it. We're very close to the prior highs. So let's see exactly how things are playing out. That sort of V-shaped recovery with the fact that we've come into this swing low at 206.65. That means that we're essentially now utilizing that as our near-term swing low. You can also look at this 21023 level. Just get rid of that. So we're sort of creeping higher. The intraday sort of hourly time frame highlights exactly that. So the question of higher highs, higher lows. The bulls are very much in charge here for the Nasdaq. So unless we start breaking out through your sort of recent swing lows, you know, your 21604, 21359, those kind of levels. If we break through those levels, then it starts looking like we're going to be giving back some of these gains. But as it stands, the bulls remain in charge. And particularly if we see another jobs report that is strong this time around, much like last time where we saw a beat in terms of the payrolls and the ADP weakness was essentially a setup where people thought it was going to come in weak. It didn't come in weak. If that happens once again, I would look at the Nasdaq as the area where we could see some strength coming into play. And if it comes in weak, then you can look towards the likes of gold to outperform. So I hope this has been useful. It's going to be an interesting report indeed, because the data that's coming out at the moment is telling us stories in both directions, right? I mean, look, we've got the stagflation story coming out of the ISM PMI numbers. We've got that weakness on the ADP number. We actually had strength in terms of the JOLTS numbers, although it's still on that downtrend. So Friday's numbers are going to be really interesting, and I hope this helps you prepare for trading around that event if you choose to do so. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Make sure to like, subscribe, and follow for more. Thanks a lot.